quite with each and every single one of you guys. As we begin to not only wind down this beginners bootcamp series, but at the same time begin to turn things up. We have went through many previous price courses where you guys got to really dive in and indulge in all of the basic education, or the more relevant basic education, because the Forex market is infinite in knowledge. But we got to really indulge in all the basic education. And now, as we're getting ready to move into the final 3 parts of this beginners boot camp, we're going to begin learning how to interpret the market. So on today's FRX Beginners Bootcamp Part 6, we're going to be diving into the basis of a price action analysis, introducing the concept of wave theories, level theories, chart patterns, market phases, so on and so forth. It's going to be a really exciting class. Our next class, we're going to dive into time and trade management, learning how to really manage your account, how to properly survive in the market. And then we'll be winding down in the very last video, which is going to be a highly anticipated video. And that video is going to be composing a trade idea. So we're going to walk through the market. We're going to incorporate all of the things that we have learned within this beginners bootcamp and really start to plot out step by step how you can interpret a trend and how you can compose a trade in terms of a price action, in terms of price action theory, so to speak. And from there, I'm going to be introducing you guys to each and every single one of the IM Mastery Academy strategy educators. So you can understand that you don't only have the ability to trade with me in the live market and get educated from me in the live market, but there are other great strategy educators here within the academy that teach on different advanced price concepts. And whichever one is a fit for you is going to be the one that you're going to be able to go with. Because at the end of the day, it's not about being right. It's about making money. And this is about your longevity. It's about your future. So I'm excited to just go ahead and continue today's beginners bootcamp. So again, one more time, good day. And I hope each and every single one of you guys are ready for what today brings. So let's start this off by saying the market is always changing and it's never fixed. I want you guys to understand that. So here's a little quote that I came up with. Traders will have to learn to adapt to different market conditions or always trade the same setup. You see, I believe that one of the biggest conflictions that traders face in the market is that at any given time when they're joining the market, regardless of the time frame, the 1 minute, the 5 minute, the hour, the 4 hour, the daily, the weekly, they're always puzzled as to what to do in the market. Is the market uptrending? Is it downtrending? Is it counter trend trading? Am I marking up a support here or resistance? Am I doing this trend line? What am I doing? And they get very confused. So it can be very difficult for a trader to just come in and say, okay, this is exactly what's happening. And the reason why that will never happen is because the market is always changing. It's continuously changing. Everything is always changing, right? It's never fixed. You'll never be able to just look at the market and say, I know definitely, most definitely what's going to happen. It's always going to be variations of either fundamental or sentimental or technical or, X, Y, and Z, whatever it is that you want to incorporate that's going to help you understand, the market, so to speak. So going into my quote, traders have to adapt to different market conditions, meaning that if a market is trending, you have to learn how to trade in a trending market. How do you identify the characteristics of a trending market? If the market's in a ranging market and moving sideways, how do you identify the characteristics of a ranging market? How do you know if you should trade the ranging market? Is it a support, resistance? Is it a supply? Is it a demand? What is it doing? Is the market pullback? Is the market in a pullback? Is the market retracing? What exactly is happening? So as the market is cycling through different market conditions, you have to adapt And that's the purpose of this education, okay? And if you do not have the ability to adapt to different market conditions, because let's say you are on the newer side of your FRX journey, or let's say you only specialize in specific market scenarios, then you're going to have to always trade the same setup. So there are many traders that are very evolved in their trading. They're able to adapt to several different market conditions and always find trading ideas. That is somebody like myself. I'm able to trade in multiple different market conditions. But there are also other traders who specialize in the same exact type of setup. They look for the same setup regardless of the time frame, regardless of the pair. This is exactly what they need to see in order for them to get in the market, and they don't do nothing else, just that. Now, I want to let you guys know, regardless if you're adapting or whether you are stationed and always trading the same setup, it honestly does not matter. What matters is that it works for you. That's the key takeaway that I want you to take from this introduction to today's FRX Beginners Bootcamp Volume 6. Due to the fact that you're going to get introduced to a lot of price concepts today that's going to help you interpret the market and start to learn how to develop the base of your analysis. So I am extremely excited to continue moving forward. Now, let's start off by talking about market cycles, the 4 market phases. So in discovering market cycles, I want you guys to understand that there is something that's always happening in the market, and the market is always in some type of cycle. So let's talk about it. Let's experience it as we go through each of these concepts. So a market cycle refers to a trend, or a pattern that emerges during different business environments. Knowing the current stage of a market cycle can not only provide accurate buying and selling opportunities, but also give tremendous advantage over other market participants. Who are other market participants? Those are the other individuals that are trading with you that have no idea what the market is doing. But by you being able to recognize and understand market cycles, you'll have a much better chance to accurately forecast the market, depending on the factors that you see happening in the market. So let's talk about this, right? Market cycles often differ for each individual person depending on what trend or time frame they're looking at. What do I mean here? I mean that there are market cycles happening on the 4-hour. There are market cycles that are happening on the daily. There are market cycles that are happening on the 1 hour. There are market cycles that are happening on the 15-minute. If you're scalping the market, there are market cycles that are happening on the 1 minute and the 5 minute inside of the market. So you have to learn how to just simply identify these market cycles. So let's begin by talking about the 4 market phases. So the first market cycle, or the first phase, is known as accumulation. And that's what you'll see right here, the accumulation phase. The accumulation phase is an institutional demand building up. So what do I mean here is this is when the market is basically moving in a sideways range. You know how the market begins to go into a period of consolidation, or as we talked about, supply and demand levels, right? Accumulation is where the market is going to stop for an extended period of time, move in a sideways range. And what's going to happen here is a lot of the banks, a lot of the institution, a lot of the key money, because remember, it takes big money for them to be able to come into the market. I'm going to give you guys a little trade secret in case you didn't know. It takes on average 10,000 lots to move the market by 1 pip. So I want you to think about that. It takes 10,000 lots. That means that you need 10,000 traders, each trading a 1 standard lot, to simply move the market just 1 pip. That's why there's so much money in the market when you're buying and you're losing, and why the leverage is able to be so high. So it's really the banks, it's really the institutions that are able to come in and push these markets hundreds and hundreds of points, within minutes or, within hours in a long, strong move that you see inside of the market. So usually when you see areas of accumulation, This is where these institutional players are trapping up the volume inside of the market, getting ready to push the market in a specific move. Now, the second market phase is known as the advancing market phase. Okay, the advancing market phase is simply an uptrending cycle. It's when you begin to see the market start to make those series of highs and lows and ups and downs, moving in an uptrending manner. This is where your technical analysis is coming into place, helping you understand key support and resistance levels, breakout and retest, pullbacks, trendings, EMAs, X, Y, and Z. Right? So you have that uptrending cycle where the market is now moving. Now, eventually the market is going to get to a point of distribution. Distribution is another word for accumulation. Distribution is where all of the people that got into the market, they're now holding off. They're starting to exit their positions, right? And then now we have more demand. Now we have, I have actually here, look, distribution says downtrending cycle, declining says institutional supply building up. So I'm so sorry. This is actually mixed up. Okay. So distribution is supposed to be institutional supply building up, and declining is supposed to be downtrending cycle. So pardon me for that if you're taking that down for your notes. Okay. So distribution is the institutional supply building up. It's the complete opposite of the accumulation. Orders are building up and they're getting ready to dump this market. And when they're ready to actually move the market will then go into the declining phase. And the declining phase is where the market is now in a downtrending cycle. So this is what's always happening inside of the market. Now, before we talk about expansions and contractions in the market, let's take a look at what the 4 market phases look like, and one little trick that can actually help you identify the market phases. So we're going to come right over here to GBP USD. All right. And we're going to look at the market right here. Now, if we take a look at the market, what I want you to notice are 2 key areas. I want you to take a look at this key area where the market begins to move in a strong sideways range. And we're going to just adjust those colors right over there. And then I want you to look right over here at this large sideways range inside of the market. Now, what I want you to notice is that within these ranges right over here inside of the market, you'll notice that once the market was officially done with this range, the market then gave us a big push up, and we began a new uptrending market cycle going all the way up till eventually the market started going into a long, strong sideways range. And now we had the distribution now building up. And you'll notice that accumulation and distribution can often also be at key areas of supply and demand inside of the market, right? So anytime that you're identifying levels of supply and demand, this can be one factor to help you understand that this is in fact a supply and demand level. Or again, just remembering your supply and demand rules, which is looking for clusters of wicks, looking for long, fast, volatile moves, or very large banking key levels out of specific areas. And often when price returns to these levels, you'll notice that this ends up becoming a new area of distribution. Okay. And after the market is done accumulating and the distribution is ready, the market will also have a big decline going into a new wave cycle, going into a new downtrending price. Okay. So this is what accumulation and distribution look like. Now, not only does it look like that on smaller time frames, on the 1 hour, it could be like this on the 4 hour. It could also be like this on the 15-minute, right? There are many, many different ways that you can interpret accumulation and distribution levels. Like as an example, over here, you have a large area of distribution happening over here, going into a declining market. And you had a large area of accumulation right over here before then going into an advancing market and the market moving up. And the market comes down and you'll see a long, strong sideways move before the market begins to go back up. And this will happen again and again and again inside of the market. Sometimes the accumulation and distribution is easy to recognize and identify, and sometimes it's not. So it's all about recognition, understanding what the price is doing and how the price is looking. Okay. Now, one thing that can help you learn how to identify accumulation and distribution, believe it or not, is that you can actually use the 200 moving average. Okay. The 200 moving average helps traders identify areas of accumulation and distribution when the moving average flattens out. Okay. Again, when you're using moving averages, exponential, smooth moving averages, McGinley's, or any variations, this helps you understand if a market's in an uptrend or downtrend. Slow averages help you determine trends. Fast averages can help you determine entries and quick shift in trends, if you remember on our previous boot camp. But the 200, if you're going to use the 200, remember that the 200 can also help you understand these accumulation and distribution levels. And how they do that is by what they call it is a flat line. When you begin to see the 200 MA start to move in a sideways range. Okay. So when you start to see, if you're ever confused and you want to try to do this, you can use the 200 MA and look for whenever the 200 MA goes in a sideways range or it begins to flatten out in a consolidating type of area. When it does that, this will help you understand to identify, okay, this is an area of accumulation or distribution, right? Now, as you can see right over here, this market began to flatten out over here as well. But this market cycle did not go bullish. This market cycle continued to go bearish, okay? So that is a very, very popular MA. And there are many variations to how you can identify accumulation and distribution zones. One thing that I've commonly been using, for nearly a decade is using that 200 MA and combining it with looking at key supply and demand levels inside of the market. So something like this would make it very, very easy to recognize for a new trader. Okay. Now let's just get rid of that. And then let's continue with our training here. Now, again, now that we understand the four market phases: accumulation, advancing, distribution, and declining, and there is a huge psychology behind that. Okay. But now additionally, I want to also introduce you guys to the concept of market expansions and contractions. All right. Market expansions and contractions repeat themselves throughout all advancing and declining drives. So what do I mean here? When we are looking at advancing and when we're looking at declining drives, okay, areas of expansion and contraction is very, very similar to accumulation and advancing, or distribution and declining on a smaller scale, I guess that you can say. All right, so let me come over here to the market and then let me identify what I'm talking about. So if we look over here, we can actually just use this entire area, and then we can even dive down into smaller areas over here. Let me just get rid of this stuff. All righty. Now we take a look over here. We understand the market phases. I want you guys to also understand this. The market, what's going to happen is that the market is always going to do something known as a contraction. So a contraction, what you see over here, is when the market is taking a break or a pause in the trend. Okay, it's taking a break or it's a pause in the trend. It stops trending and then it just starts to go in a sideways movement. And then eventually what ends up happening is that when the price is ready to make another drive, the price will then go into something known as an expansion over here inside of the market. So let's take a look, right? We'll use this as an expansion and we'll say that this right here is a contraction. Now, once once the market has been expanded, the drop has been made, the move has been made, whatever the case is, the market then goes back into the next area of contraction. Right over here, if we take a look, the market goes back into the next area of contraction. This is where the market again begins to move in a sideways type of manner. And when the market is done moving in a sideways type of manner, the market will then repeat itself and go back into the next expansion inside of the market. So a good way to help you understand this is that contractions, market moves sideways, market moves slow, the market is ranging, the market is accumulating, the market is distributing, however you want to identify this area. But understand that this is where there is slow money. This is where volume is getting trapped up. This is where you not want to be. You see something like this, you just got to say to yourself, not interested. I'm not interested. You want to use these areas as setups to be able to understand the volume breakouts in the market, okay? The expansion is where you want to be. The expansion is where all of the money is at. That's where the long, fast money is coming in. That's where you want to be. Those are the moves that make you love Forex, make you want to trade forever. You know, you're praising God, the high waters, the heavens. That's it. You're telling everybody about Forex trading. But then for the traders that get caught up in areas of contractions and they don't know what they're doing, they're like, oh, well, it looked like it was going to come down, but then it went up. And I thought it was going to go up, but then it came down. And I hate Forex. Don't do it. It's a scam. Right? Sounds like you when you're winning and losing. So this is how it works out. Okay, so you want to get into those areas of expansion and contractions. Okay, so here, let me show you a market cycle. So let's say you were looking at this market cycle over here of accumulation and distribution. Now we could look at this multiple type of ways. Okay, so we could look at this as, let's say this is the accumulation, and then let's say this is the distribution, which it is right over here. Okay, let's look at this advancing market going up over here. Okay, we could look at this advancing market like this: expansion in the market, contraction in the market right over here. Pardon the delay on the laptop. Okay, and then let's go back to coloring this. Unfortunately, we're back to the computer getting delayed. Yeah. All righty. And then we go from here, then we go back into the next expansion. And there are ways to identify this, and we're going to be diving into that. But it's just important that we just help you understand piece by piece what we're talking about. Then we go back into some type of contraction right over here in a sideways motion. And then we go right back into the expansion. Bingo, right over here. All right. So we see throughout the market phases, there are expansions and contractions during the advance, and then also during the decline in price. Okay. So let me show you. Now, again, when you zoom into these areas, the market is going to continue to do that, because in here, you have a phase of distribution and a phase of accumulation, a phase of distribution and a phase of accumulation, a phase of distribution, a phase of accumulation. So these, again, these market phases are happening repeatedly inside of the market. All right. So let's say we're looking over here. Let's dive a little bit deeper. If we're looking at this, what do we see? We can see that the market was contracting there, and then the market went into an expansion. And then we can see that the market was contracting here, and then the market went into an expansion. And then we can see that the market was contracting right over here. Bingo. And then went into an expansion. I hope this is making sense for somebody, because this is where we're going to stop this. Now, this is just extremely important that you guys understand this psychology and the behavior of this market. Boom. Expansion. We're going back into contraction. Okay. Bingo. And then the market will just repeat this pattern again and again and again and again and again throughout the market. The psychology is just as simple as market balance or as simple as equilibrium. You have to remember that in the financial markets, supply and demand does exist, right? High and low is relative, right? Support and resistance is relative, but supply and demand is the real concept. It's understanding that when something is overpriced, it's going to have to take a break and then drop off. And then the market's going to have to take the next break. So that way the volume can then, right? The orders can then rebalance out before the market goes into the next expansion. And then it goes into the contraction and the market has to rebalance itself out before going into the next expansion. And this is why many a times traders will sometimes use, again, these Fibonacci tools. They'll look for, okay, the market extends and pulls back. There goes the contraction. It pulls back. It's resting. It's recovering 1/3 to 2/3 of the market, sometimes deeper, sometimes more shallow. And then you'll see the market will do it again. Okay. Big expansion, market pulls back 1/3 to 2/3 of the market, sometimes deeper, so that's 7-8, sometimes more shallow to that 2-3, as talked about on our previous boot camps discussing the Fibonacci sequence and tool. Okay, so that's the concept. And again, we're just playing the bank's game. So it's really about understanding when you're mapping out price, it's about understanding the order flow. We continuously talked about that theme, which is the order flow. We're going to begin to dive into the order flow as we move on from this section here. But please remember that the market will expand, contract, expand, contract, expand, contract. When the market is contracting, that is where the volume, right, and the orders are building up. And then eventually there's going to be a big breakout. And then the expansion is where your money is going to be at. And then the market is going to level out, and then it's going to be the next expansion. So always remember that when you're identifying highs, lows, support and resistance, supply, demands, trends, patterns, waves, levels, whatever it is that you're identifying, remember that the market will repeat this sequence. This will help you a lot in determining, where you want to buy and where you want to sell. All right. Now, moving forward from talking about the 4 market cycles, I now want to start to help you guys understand, well, what is wave analysis? Okay. So wave analysis is another way that traders can also interpret trends inside of the market. All right. So wave analysis is something that was developed by this gentleman, Mr. Elliott, and he studied over 200 years of stock data, and he learned that the market moves in a 5-3, basically in a 5-3 sequence, and it repeats this patterns on every time frame from the daily, weekly, yearly, all the way going down into the minute and even below the minute, and the market is constantly repeating itself in this manner. Now, while wave analysis can get extremely, extremely deep, we're gonna only scratch the surface of each type of these base analysis. Okay. So let's talk about what is wave analysis. So the wave theory is a form of technical analysis that looks for reoccurrent price patterns, related price patterns, meaning those pushes and those corrections, those pushes and corrections, okay, related to persistent changes in investors' sentiment and psychology. What does that mean? That simply means that the reason why the market is repeating this pattern, much like the discovering the market cycles of the banks accumulating, advancing, distribution, and declining, or the expansion contraction where the market needs to make a big move, rebalance, make a big move, rebalance. Okay. This is like the same concept. It has to make a big move and then balance, make a big move and then balance. But this concept was more so to understand the sentiment and the psychology of the person, because people are usually trading with their emotions, which is fear or greed. Oh, the market's going very high. I need to jump into that market. It's going to keep going higher, then the market pulls back. oh, the market is pulling back. I think the market is turning around. It's going to come down. I'm going to sell. And then the market shoots back up. And you're like, what is going on? Well, this is how the wave analysis, it was that sentiment and that psychology factor ended up creating these patterns, these wave patterns inside of the market. Now, this theory identifies impulse waves, that set up a pattern and corrective waves that oppose a larger trend. Okay, so let's talk about the wave sequence. We'll dive into this and we'll continue moving on. Now, the wave sequence. The wave sequence is 5 waves that are basically moving in the direction of the main trend. Okay, so let's talk about this. 1, 2, 3, 4, 5. Okay, 5 waves moving in the direction of the trend, followed by 3 waves in a counter trend correction, which is 1, 2, 3, right over there. This 5-3 move then becomes 2 subdivisions of the next higher wave move, meaning that after you see a 1, 2, 3, 4, 5 waves up, right? There goes the 5 impulse waves with the trend, 1, 2, 3, 4, 5. Followed by a 3-wave correction against the trend, which is 1, 2, 3. This 5-3 sequence, once this completes, this becomes part of a larger trend. So if we take a look here, let's take a look. Inside of here, you have 1, 2, 3, 4, 5, followed by the next 1, 2, 3. Now, once that completes, that becomes a part of the bigger wave. Then we have a 1, 2, 3, 4, 5, followed by a 1, 2, 3. Followed by a 1, 2, 3, 4, 5, right? So you have 3 to the trend, 3 with the trend, 3 against the trend, followed by a larger 1, 2, 3. And once this one cycle is complete, it becomes part of this bigger cycle. When this bigger cycle is complete, it becomes part of this bigger cycle. And then this just continues to happen again and again and again and again. Now, I want you guys to understand that wave retracements and extensions vary in price and time. So you have to combine price and time analysis. We're going to be diving into time later on in this training. So you want to combine price and time analysis for an increased probability. Okay, so let's come back over here to the market, and then let's see if we can back all of this stuff up over here, right? Let's back all of this stuff up over here. We were talking about all this wave and stuff happening over here. All righty. Now let's go back over here, because again, everything is one and the same. You're just interpreting the market in a different way. So we're talking about a wave sequence. The wave sequence is, let's come over here. Are you ready? Expansion, contraction, or pullback. Expansion, contraction, or pullback. Expansion. Now, if I stay over here, remember, as we begin to dive into the Fibonacci's, we were talking about how different Fibonacci levels help us understand pullbacks and extensions, help us understand where the market will come to before turning around. So let's look at this market. The wave sequence will give us from low to high. We'll come over here and give us a look, that 618 pullback. And then what happens from here? We now take this Fibonacci. Now that we have the retracements area, let me actually mark this up nice and clear for you guys. Hold on. So we have the retracement area usually giving us 1/3 to 2/3 of the pullback right over here. There we go. And then once the market is done pulling back, we talked about how the market can extend. And then we're going to go ahead, we're going to reverse these Fibonacci's to create the extension. And what ends up happening? Now, once the market extends, where does the market extend to? Well, the market can extend to that 138.2, to that 1618 range before that extension is complete. Bingo, there goes the extension. And now from the extension, the market pulls back. So let's do the pullback one more time. Now I have to reverse these fibs. Give me just one moment. Here we go. Put the fibs back to normal. There we go. So now the market gives us that next extension, that next wave, and then the market pulls back. And where does the market normally pull back to? Between 1/3 to 2/3 of the move, between the 38.2 and the 618. Bingo. Right over there. And look how it pulled back there. And from here, we're going to take these Fibonacci's and then we're going to reverse them, because now we want to be able to find the extension inside of the market. So let's take this retracement from high to low. Oops, pardon me. I showed you two different ways to do the extension, pardon me. And then let's do the extension from over here. And where does the market go? Between that 138 and that 1618. So now if I get rid of these Fibonacci levels, I want you to take a look. Let's delete those Fibonacci levels. I want you to take a look and see how the market wave sequence, ended up following the Fibonacci retracements and followed the Fibonacci extensions. And this happened all between a market cycle of accumulation and a market cycle of distribution. So can you see how this ended up working out together? So if we look over here, price has accumulation, price has distribution. Now, again, there's an advancing and a declining market. Remember that advancing is an uptrending cycle, and then the declining is a downtrending cycle in the market. So the wave analysis helps us understand the advancing and the declining cycles that are happening inside of this market. Now, obviously, when you get into wave analysis, this dives deeper into an advanced price concept. If you guys remember in the very beginning of the Forex Bootcamp, when we began to talk about that this is a basic training. So we're introducing different concepts of price action. And there are advanced concepts there are advanced price concepts that people use to incorporate in their strategy. Something like this would be known as an advanced price concept. So what I'm showing you right here is very surface level. This can go very, very, very deep inside of the market. All righty. Now, as we come back over here, let's push forward and then let's talk about the next, pardon me for all the pauses. Let's talk about the next base analysis. Now we also have something known as market levels, okay? So market levels is, again, helping us understanding areas of accumulation and distribution and advancing through prices. So depending on the advanced price concept that you're using to, create your analysis and interpret the trends and the pullbacks XYZ in the market, if you're not using a wave sequence, you'll find that other traders may use a market levels inside of the market. So let's dive into this. So the levels theory is another form of technical analysis that looks for bullish and bearish market cycles related to institutional order flow, okay? The theory looks to find peak high formations and peak low formations and then identify all of the features of a three-tiered cycle in between, okay? Three-tiered cycle. So let's talk about the level sequence. So you have the accumulation followed by three bearish pushes followed by a 3 bearish sequence, which is the MAAW. So as an example, right, you have the distribution up here, you have the accumulation down here. So in a bearish cycle, you're looking for 3 pushes. So 1 push, 2 push, 3 push, right? 1 push, that's that level transitioning. 2 push, that's that second level transitioning. The 3rd push, doing that 3rd level transitioning. Okay, the bearish cycle is commonly known as the MAAW, where the market will make an M variation, so some type of M pattern variation, which we'll get into, which is a market structure reversal pattern. Then the market will pull back, giving us an A, giving us that next push, pull back again, giving us that next kind of A formation, going down to its final level, and then giving us the next reversal, where we'll then look for the W pattern for the bearish cycle to end, the accumulation to start, and then the market to go back into an uptrend. So an additional accumulation is followed by 3 bullish, by a 3 push bullish sequence, which is known as the WVVM. So now you have the WVVM. So we see the W, there goes the 3 pushes, push 1, push 2, and push 3, bringing it to the top. So we can see the W, and then the market pushes up, giving us that pullback. There goes the V. The market pushes up, pulls back, gives us that next V formation, pushes up, and then gives us another M pattern variation, okay? Before that sequence is done, right? The 3 push sequence factors in price levels used by the traders, okay? So when people are trading in the market, they will use these levels basically, right? So you'll see there is level 1, level 2, level 3. So if there's an M, it pushes it to 3 levels, AAW. And then if it's a bullish cycle, the 3 levels, it starts at the W and then it goes VVM. All right. So those are the 3 levels up, and then these will be the 3 levels down. And then the traders will use these levels as their areas of support and resistance inside of the market. Just as how wave traders are using the pushes up and the pullbacks as their level. So if you look at this, this also looks like, let's say there was a distribution, there goes the V, there goes the V, and then there could be some type of M variation before the market goes down, okay? So that's how it is. Now let's come back over here, pardon me, let's come back to the market and then let's take a look at it, because again, these are all different, they're all doing the same thing, they're just different ways of interpreting the market. So if you look over here, what do you see? You see a W, there goes a V, there goes a V, then the market giving you some type of M variation right over here. Market goes high, boom, boom, there goes an M variation. And then what happens? We get a big decline in price. There is a huge V formation happening over here, or happening somewhere over here, depending on where you want to identify that V. Boom, the market makes a V. This is the level. And then the market's going to give us that next big push. Okay? Just like that. All right? And the market, again, it does this on everything. Look, if you look down, let's look down here. Okay, let's get rid of this. And then I'm also going to show you on a larger time frame as well. Okay, so let's take a look over here. The market right here will have some type of W pattern. There goes W. There goes the push, V. Picks up the next push, V. Goes to the top level, giving you the variation of the M, depending on, how you want to identify the M. Okay, giving you some type of M. Boom. And then what does the market do? The market pushes down, giving you a V, boom, pushes down, next push gives you a V, pushes down, and then gives you a variation of the W, and then the market pushes back up. W, V, V, boom, pushing up, giving you a potential M. But all throughout this, what do you also see? Again, I want you guys to see this. Here goes accumulation. Here goes distribution right down here. Here goes accumulation, right? Accumulation, distribution, accumulation. What do you see? Accumulation, expansion. From expansion, contraction. From contraction, expansion. From expansion to contraction, from contraction to expansion. Again, market expands down, boom, giving us a contraction. Market expands down, boom, giving us a contraction. Market expands down, boom, giving us a contraction. And then at the same exact time, what do you see? You also see the wave sequence. 1, 2, 3, 4, 5, followed by some type of 1, 2, 3 inside of the market, and then the market starts a new downtrending cycle, and it does the same thing. All right, market comes down, pushes up, there goes wave 1, pushes down, there goes wave 2, pushes up, there goes wave 3, pushes down, boom, right down there, and then gives you another 3 type of pattern. 1, 2, and then a 3. Okay, so you see, just pardon me. Give me just one moment here, guys. So as you see, these market levels, these wave levels, and these market cycles are essentially one and the same thing. They're interpreted different. They can be found on different time frames. You can trade them differently. You can do different things to identify these things. So while they are one and the same thing, they are also different. I don't know if that even makes any sense, okay? So while they are one and the same, they're also different. But it's the concept that I want you to continuously understand. Accumulation, advance. Distribution, advance. Accumulation, accumulation, advance, right? So the market is going to do the same thing with the levels. And if you want to begin to learn how to find the base of your analysis, to understand what's going on, these are going to be the type of things that you have to begin to dive into, indulge in, and master. You're going to have to learn these things. And one more time, market levels, again, it goes way, way deeper than the MWWA and the WVBM cycle. This is just surface level. Remember that market levels vary in price and time, and you have to combine price and time analysis for increased probability. Okay, so same exact thing with the wave, same exact things with this. Now, moving forward, we're going to now start to talk about identifying price patterns inside of the market. Now, price patterns are extremely popular within the Forex world. They're known as cheat sheets, right? They're kind of known as cheat sheets where a trader can identify, a type of price pattern. And then by identifying the type of price pattern, it can help them predict, what's going to happen. So let's take a look at this. Price patterns are distinctive formations created by movements of prices on a chart and are the foundation of technical analysis. Traders use price patterns to examine current movements and forecast future market movements. Okay, so you'll see many traders, they'll trade the double top, which is the M, or the head and shoulders. You might see them trade a triangle in the market, or a wedge, or a pennant, or a double bottom, right? Or whatever the case is. Now, I want you guys to understand that there is a lot of controversy surrounding price patterns inside of the market. And that's because price patterns are not essentially cycles in the market. Like if we talk about the 4 market cycles, if we talk about the wave analysis, if we talk about the level analysis, these are not price patterns. These are market cycles. These are market patterns, okay? These are each market cycles, they're market patterns, whatever it is, market phases, whatever it is that you want to call them, okay? Price patterns can help you identify market levels, can help you identify, pullbacks in the market, can help you identify, market cycles. Okay. So price patterns are not meant to be traded blindly. You don't want to just find the price pattern and just trade the price pattern, because you can get caught up on what's known as a fake out. Because I want you guys to remember that while price patterns can be easily identified, and that's why they're so popularized, I want you guys to remember that the brokers, the banks, this is kind of like their playbook. These were created via psychology, and the banks and the algorithms are aware, just like how they're aware of the levels and the analysis and the cycles and X, Y, and Z, just like how they're aware, they are aware of this. And many times traders can get a massive stop hunt whenever trading price patterns, because they don't know how to trade price patterns properly. So it's not always as easy as, double top, break and retest, and boom, let's go. It's not always as easy as, falling wedge, break and retest, boom, let's go. Let's get into the market. Okay, it's not always that easy. So you want to use price patterns to aid you. You want to be very aware of these, and you want to let price patterns aid you going back into your market levels, aid you into your wave analysis, aid you in your market cycles, okay? And if you combine this with those other theories, and you get very good at identifying this, I can absolutely promise you that you will not have an issue trading in the market. The only thing that would be the death of you is your risk management in the market. That's what's going to be the death of you, is your risk management. Okay. So pardon me, hold on. Guys, I'm so sorry. So let's dive into the price patterns. We're going to spend a little bit of time here, right? Now, price patterns. A pattern is identified by a line that connects common price points, such as closing price or highs and lows during a specific period of time. So you're using the highs and the lows, the opens and the close. You're using the candlesticks to help you create price patterns in the market. Okay. Now there are 3 type of price patterns, or 3 sequential price patterns, I guess you can say. Even though there are 3 type of sequential price patterns, these fan out into many different type of price patterns. As an example, you have reversal patterns. So reversal patterns help you detect or aid you in the change of a trend. So as an example, let's look, what are reversal patterns? Reversal patterns are things known as double tops and double bottoms. Those are those M's and those W's that happen inside of the market, right? So let's come over here. So we're looking at cycles. You see those M's, bingo, and then you'll see those W's right over there. That will help you understand. It doesn't mean that every W, right? Like look at here, this made a W, 1, 2, 3, 4. Traders could have thought it would have broken retest and went up, but no, it didn't. It continued dropping down. Again, there are key features, key things that you need to see in order to validate these patterns and these levels and stuff like that, okay? So just remember that. Okay, so double tops, double bottoms can help you understand when a market is getting ready to reverse. You also have things like the head and shoulders pattern, or the inverted head and shoulders patterns, right? And if you're looking at areas of accumulation or distribution, you might notice that you will see head and shoulders patterns, right? Where the market was coming down it made a low, and then the market slowly started to turn up before advancing, or the market was in a distribution and it slowly was coming up before it stopped, and then it slowly started turning around before it started declining. Okay, Head and Shoulders will help you identify that. Then you also have things known as rising wedges and falling wedges. Okay, rising wedges and falling wedges help you, or is something known as leading or ending diagonals inside of the market. So sometimes when you are in a wave sequence, you might see the market giving you a leading diagonal, or you might see the market down here giving you an ending diagonal, basically wedging, right? Getting trapped into one small area before the market explodes, before the volume explodes. So before we dive into the market, pardon me, let's come over here. Before we dive into the market, those are the reversal patterns. Now you also have something known as continuation patterns that are happening in the market. Continuation patterns help you identify the continuation of a trend. So when the market, let's come back over here, when the market is advancing or when the market is declining, right? When the market is basically, pulling back, making those corrections before continuing in the direction of the market, you can see continuation patterns. When the market is giving you these levels, you can identify continuation patterns within those levels inside of the market. All righty. Continuation patterns help you forecast the continuation of a trend. So you might see falling and rising wedges, just like how you've seen over here. You see how these reversal patterns, this rising and falling wedges, this is based on if the market is uptrending, you'll see that the market will then come down. If the market is downtrending, at the end of a falling wedge, the market will come up. But now if you change the direction of the trend that you find them in, they can be used as continuation patterns. So as an example, if the market is uptrending, okay, it'll give you a falling wedge, which will keep the market going up. So you'll see here how the market was giving us a falling wedge, and here we had the market giving us a falling wedge. The only difference was this market was coming down, falling wedge, market turned back up. But in this market, the market was going up, gave us a falling wedge, and then continued to go up. So whenever you see a falling wedge, that's always a bullish sign that the market's going to go up. It just depends on where you found it. And we have advanced trainings on price patterns, and I'll show you guys how to access those in a moment. So you have falling wedges will help you determine the continuation of a trend. You have rising wedges that will help you determine the continuation of a trend. You have things like bullish and bearish triangle, or bullish and bearish rectangle patterns. They're basically sideways flag patterns, okay, that are happening inside of the market. Okay, these are known as flags that are happening inside of the market. Flag poles, these are very, very popular. And then you also have bullish and bearish pennants, which basically look like continuations, but they're very, very, very small. They're very small triangles in the market. And then you have something known as bilateral patterns, okay? Bilateral patterns can be a change or a continuation of a trend. So many traders will get trapped up on a bilateral pattern. So bilateral patterns are things known as ascending triangles, where you'll see a resistance and then you'll see the market beginning to, create higher highs, going into a flat top, and then the price gets bottled up. And here the market can either push up or break down. Same thing with a descending. If the market's coming down and gives us a flat bottom or gives us an area of support and then contracting lower lows, the price will bottle up and it can either break up or break down. Or you might even see something known as a symmetrical triangle, which is a larger contraction of price, and the market's making huge moves. This market can either break above or break below, right? So bilateral can be a change in trend or a continuation of trend. And one more time, you use this to aid you in your market levels, your waves, or your market phases. So let's come on over back to the market. And then let's take a look at how this works out, right? Pardon me. Give me 1 second, ladies and gentlemen. Let me delete this. Okay. All right. So let's talk about market patterns over here, right? Lots and lots and lots of market patterns, right? So remember how we just talked about that Elliott wave right over here? We talked about that wave sequence. Let's say I want to go up to the 4-hour or the daily. Because I'm going to show you the other cycles that happened over here, and then I'll show you a larger cycle. So let's take a look at a larger cycle over here. All right, let's take a look at a larger market cycle over here. Right, so we have, oof, pardon me. There we go. All right. Hold on. This thing is lagging. 1 second, ladies and gentlemen. All right, there we go. All right, there goes one. Market pushes down. Market pushes up. Market pushes down. Market pushes up. Okay, so let's take a look over here. All right, so if we're looking over here, let's say we're looking right over here in the market. Within these, and again, this is on the daily. Now, this can be found on every single time frame. Now, if we look over here, look at these different type of price patterns. Like over here, you had somewhat of a flag pattern happening over here inside of this market, right? Boom. Before the market gave us a strong break-in, you had a sideways flag pattern. You also have, let's come over here. Let's say I want to do this. You also have another type of pattern right over here. Let's see. Was this a flag or is this a, okay, there we go. This is a falling wedge. Boom. Now we also have a falling wedge happening over here. So I want you to take a look at how there are different type of patterns that are happening inside of the market. Let's come over to the 4-hour. And again, I'm being very, very surface level with what I'm showing you here, because these concepts can go very, very deep. Let me come over here to where I created these other market cycles over here. Give this computer 1 second as it adjusts. There we go. Okay. So let's take a look over here. All right, there we go. Let's take a look over here. All righty. Now we look over here again. Here goes the cycle MAAWWVVM. What's happening over here? You have 3 pushes. You have 3 waves inside of the market. However it is that you want to identify it. Now, if you look over here, you'll notice that each of these pushes, each of these levels, were giving us specific type of patterns, right? These right here were giving us, let me come to the low. Okay. Pardon me, bingo and bingo. Boom. So we can see here that this ended up giving us a flag pattern pushed up. The market gave us another flag pattern and then ended up pushing up, right? So you see how those helped us understand the continuation of that trend. And then here goes the W pattern that helped us give the confirmation that the market was going to go up. Here goes a sideways flag pattern that helped us understand that the market was going to go down. All right, boom, boom, boom. And the market was going to go down. All righty, let me show you other type of patterns. Let's go back down. Let's do a 15-minute and let's go to something more relevant. Okay, I can be all over the place with this. So let's come down here. Let's take a look. Okay. Now watch this. Look at how this market was declining right over here. right? I want you to take a look. All righty. Now you see here how this market is making a series of lower highs, lower high, lower high, lower high, lower high. Now, if we go back to the previous beginners boot camps, we talked about that lower highs help you identify downtrend. And then what you can do is that you can take these levels and then you can use these levels as areas of support and resistance inside of the market. Now, if we look down here at where this price began to accumulate before going back up, look at what happened here. The market gave us a low, high, low. Market pushed back up to the previous high. The market pushed back down, creating a new lower high, a new potential lower high, and then pushed back up over here. Now, if you can see this, ladies and gentlemen, let me come over here. If you can see this right over here, this market structure reversal actually gave us something known as an inverted head and shoulders pattern right over there, which is a market reversal pattern. Now I'm going to give you guys a little tip. Did you guys know that the head and shoulders pattern is averaging 80 to 85% accurate in terms of a market trend reversal? So anytime that you accurately forecast an inverted head and shoulders or a head and shoulders pattern, as you see over here, let's take a look. 1, 2, there goes the head right over here. There goes the shoulder right over there. This pattern can help you identify a market structure reversal where the market went from making a series of higher highs to a series of lower highs inside of the market, right? There goes another type of pattern. Now, as we go back into this, I want you guys to remember that, again, price patterns are here to aid you in your overall understanding of the market. So remember that price patterns vary in time and price. So you want to combine price and time analysis for improved price projections. And that's what we're about to get into. We're about to get into time analysis right now, which is going to help you with your price patterns. It's going to help you with your market levels. It's going to help you with your wave analysis, and it's going to help you understanding your market cycles. Time plays such an important role inside of the market. It's one of the most overlooked things because I believe that it's probably too complex for individuals. But I'll tell you this, ladies and gentlemen, if you can begin to master time analysis, you are going to take your trading game to the next level. Now, before I get into time analysis, I want to make you guys aware that you have the ability to learn more about identifying price patterns, more about identifying wave analysis, and more. Now, if you guys come on over to my Go Live channel, all right, if you guys come over to my Go Live channel, where you guys are currently viewing the market right now, I want you guys to remember that under this, now you might see a new version of Go Live depending on when you're looking at this. This could be the previous version of Go Live. There might be a new version of Go Live. But what's always going to remain constant is that there's going to be an ability to see our previously recorded sessions, and you're going to have the ability to watch favorite sessions. Now, if you come to my favorite sessions down here below, not only can you find each of the FRX Beginners Bootcamps, you can also find additional trainings if you want to dive in deeper into those advanced price concepts. Now, if we come down, I have a 15 course masterclass on wave analysis known as market geometry. And you'll notice that the market geometry has an intro and it goes into class 2, 3, 4, 5, and it goes to about 15 volumes. And there are going to be, when you come and you look at this, there's actually going to be a cover art. So it's going to be labeled on the cover art. And if you scroll down a little bit deeper, if you want to get into understanding price patterns into the market, Okay, as you come deeper, I already started updating the cover arts. You will also notice that I will have additional trainings breaking down each of the price patterns, triangles, wedges, the cup and handles, the flags, M's and W's, so on and so forth. So you can come down if you want to get deeper and truly understand wave sequences and truly understand price patterns inside of the market. You may, in fact, come and check those out to continue your education, and always be on the lookout for new training series that I have developed that I put right here in my favorite section for you guys to attend. All right. Now, anyway, coming back, let's move into incorporating time analysis into your training. All right. Now, we're going to first talk about Fibonacci time zones. All righty. Now, Fibonacci time zones are vertical lines, which is what you see here. Vertical lines are vertical lines based on the Fibonacci sequence. Now, these lines extend along the x-axis, which is the date. So you'll see that they'll go to different dates. Okay, it's not really so much about the time. It's not a price thing. It's a time thing. Okay, so these lines will extend along the x-axis, which is the time axis, as a mechanism to forecast reversals based on elapsed times. Basically stating that every single time the market comes right over here to one of these levels, or when the market passed one of these Fibonacci time zones, this is letting you know, okay, the market can reverse at this area. When the market crosses back over the next time zone, okay, you can look for another potential reversal. The market crossed over this time zone, okay, begin another potential reversal. And if you see this was actually, if you go to the daily on USD Chef, I believe that this was the sequence I got. This worked out perfectly on the daily, giving us all of the reversal levels for USD Chef, I believe it was. Now let's get into Fib time zones. So Fib time zones are often plotted at major high or low points, right? So that's the biggest question here is, okay, when do I use Fib time zones? How do I use Fib time zones? How do I plot Fib time zones? So Fib time zones are often plotted at major high or low points. Pardon me. Fib time zones are often plotted at major high or low points as the starting point for the trend. So you see here, I use two low points. I use this low point and I use this low point to then forecast the rest of the time zones. Okay. So the distance starts relatively small. So, you know, the boxes will start small, 1, 2, 3, 4, 5, 8, 13. It follows the Fibonacci time sequence, and then it will begin to extend into larger time zones. And when the Fibonacci time zones extend into the future, this is what helps us anticipate those potential reversal points inside of the market. Okay. Now, these are ways that you can connect the Fibonacci time zone. So you can connect the retracement points if you're looking for retracement reversals. You can connect the extension points if you're looking for extension reversals. And then you could plot previous high and lows if you want to attempt to find the reversals for an entire market cycle. Okay, so remember this, that Fib time zones vary depending on the plot points. So they will change depending on where you plot them. So learning how to plot them or discovering your method and how you plot them is extremely important in the market. So again, you want to combine time and price analysis for increased reversal probability. Now this is price. Remember that this is time. Price patterns is price. Market levels is price. Wave analysis is price. Market cycles is price. These are price analysis. And you want to combine price analysis with time analysis. I am now showing you time analysis. So you want to combine this time analysis with these price analysis. Are you getting it? This is what you want to start using together to help you plot reversals points in the market. So I'm going to show you how to do fib time zones. Now, fib time zones are my least favorite. I like to use trend-based fib timelines. This right here is my go-to. I'm going to show you how to box up specific zones, okay? And that's because this is a much easier. Trend-based fib time is a lot easier than fib time zones, believe it or not. But fib time zones are just as powerful as seen on the chart if you use it right. But it's all about the plotting the right areas. So please remember that you want to incorporate time and price, meaning that I'm going to, before we jump over to the chart, if the price returns back to, let's say, a turning point, right? It could be high or low. It goes back to a turning point. You're not going to just say, oh, it's going to cross over and go bullish. No. When the price crosses over, that means that the time elapse has completed, and now you want to incorporate price. So you want to find some type of, let's say in this example, you want to find some type of price reversal or break and retest of, you know, what we see over here is an accumulation zone to then take the market up. Okay. So time and price. So let's come on over to the market and then let's work to identify time and price. So let's come over here to the 1 hour and let's see what we can do. All right. Now, I didn't want to delete all this, but I'm going to have to. So let's just delete all this. Remove. You know what? Before we remove drawing tools, let's come on over. I'm going to show you multiple examples, but let me show you the market levels. Anytime I want to show you those larger market levels that I had over here before. Now watch this. Give that 1 second. All righty. Let me come back to these larger market levels. We're going to have a lot of fun doing time right now. So let's get ready to learn. Okay. Let's auto this out. Let's come over here. Okay. Let's look at these market levels. Now, again, this is what I like to do. So what I do here, let's come back. I like to connect the retracement points, which means that if the market's in an uptrend, whenever the market pulls back, I like to connect the lows in an uptrend, the retracement points, to find future retracement points. If I'm in an uptrend, I like to connect the extension points, which is the high, to find the extension reversals. Okay? So let's take a look over here. I keep going back and forth, pardon me. Okay, so let's take a look. So if the market is going to, again, you want to find the reversal levels. I'm going to come over here. I'm going to take my fib time zone. Okay. And then I'm going to try to connect these reversal points. So from the market low to, let's say, the market low right over here. Okay. So let me see. Should I put it here? Let me just zoom in. Okay, let me try to get it along these bars specifically over here. Okay, so let's say I have some of the lows. So I want you to look at these time cycles. Okay, I want you to look at these time cycles. So I connected the first low of this M pattern. So when the price finally broke out and created a new low and pushed back up. And let's say the market was downtrending over here. Now, once I'm using this, I can use this to find, again, additional reversal levels. When did the price, again, turn over? When did the price turn over? This is moving slow because it's frozen. Okay. When did the price then turn over? I ideally actually want to connect smaller lows like this in the market over here. So let me connect these last lows, right? Look, you have this low, which is over here, gave you lots of reversals. You have this low over here. So whatever the case is. So let's say we connected those lows inside of the market. Look at how when the market elapsed over this area, the market then reversed back up. Look at how when the market elapsed over this area, the market then started turning back up. Look at how when the market elapsed over this area, the market started turning back down, right? So there are different ways to use it. Let's say I wanted to use this market low with this market low over here, okay? Now I'm using these market lows and look at what else is happening over here, okay? I use this low to, let me see if this is an accurate low. I could use that, even though this is a much low point. There we go. Okay, that was the real bottom out. So let's say I use those lows over here. Look at how when I use these lows, this low to this market low before the price and drove down, it now gave us this low. Look at how the market elapsed. It turned over there and turned up. Look at how the market was coming down here, elapsed, eventually turned over, and then went back up. Okay, so that's like that. Let's say I wanted to use it from the high points. I can go from high to the high right over here. Now, if I use this high to this high point over here, look at what happened. And again, I'm using the lows to try to find where the market was going to turn up, right? Now I'm using the high points, or I'm using the extensions, or in this case, the retracements, to see when the market is turning back over. So from this high point to this high point, look at how when the market pushed back up to this high point, the market elapsed and came back down. But now the market ended up turning over. Look at how here the market elapsed and then turned over and went back up. So you see, time zones are extremely powerful, but you have to know how to use them and when to use them. And because they're so subjective, they're not quite like my favorites. But trust me, they can be used to a great deal. So let's come over to the 1 hour chart, and then let's look at something more relative to price, and then see how to use it. Because they are easier to use, in my opinion, on smaller time frames, right? Now, let me show you here. Let's remove drawing tools. All right. Let's come over here to GBP USD. All righty. So let's take a look at this market right over here, right? See how this market is like kind of downtrending in a sense over there? And then this was the low. Here we go. There goes, this is the entire swing, okay? Here goes the low. You have this low, and then you have this high over here. All righty. So now watch how I use time in a different sense. So I could attempt to take from this low all the way to this high, and then I can try to find my time cycles like that, right? And again, it could be subjective. Let's say it was over here or over here, whatever the case is, right? Let's look at these time cycles. So if you look over here, if I take from low to high, the entire move, I'm attempting to find the reversal points here. So look at here how there was a time elapse, and then the market pushed up. And then the market came down, and then the market pushed up. And then there was a time elapse, and the market crossed over. And now the market started going down. Okay, that's a time elapse. That's trying to use the entire swing point. Let's say I wanted to use the Fibonacci time zones from the high to this low point over here. Okay, let's say I want to use this high to this low point. Look at how this one worked out a little bit better, right? I went from high to low. Here goes the time elapse. And then the market turned over. Here goes the market was coming down. There was a time elapse here, right? And depending on how you used it, the market either went below, or after the time elapsed, the market started going up. And look at over here. Here goes another time elapse. And when the market crossed over, it went up. Look at this time elapse here. The market crossed over and it started going lower, right? Look at this time elapse. This was actually a very nice area to plot it over. Look at this time elapse. Boom, market crossed over, market started declining. right? Let's say I was looking at, let's come over here, okay? Let's take a look at these points. So from this high to this high, or let's say from like this low to this low. This is where the market structure started reversing and going in an uptrend. So let's say I want to do from low to low right over here. Again, there we go. I have that time elapse. Now, what do I see over here? This is helping me understand, okay, well, where can price turn around? Look at here how price turned around from there and started coming down. Look at how price came up, turned around there, started coming down. Look at how price came over here, turned around and started going up, right? So again, because my chart is so wide, I can see a lot of market data. Usually traders are not looking at that much market data in the market. But if I zoom in, let me show you how the time elapse works. Look how price crossed over and began to come down over here on GBP USD. Even if you did the retest of that time elapse over there, that was nearly a 100 pip drop inside of the market. Let's come over here. Look at this time elapse over here. The market came up, time elapse, combining price. Look at this area right over there. It's a beautiful area of supply in the market. Look, you have consolidating market, long banking candle right out that zone. Price pushes right back into that zone. There goes a time elapse. Market started pushing down. Okay. Let me move this over. Okay, 1 second. This chart is freezing up again. Okay, there we go. Look at down here. Market was coming down. There goes a time elapse. The market turned over and ended up pushing back up. So as you can see here, using fib times can be very, 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 very powerful. It just all depends on where you use it from. So as an example, let's say I was taking this range right over here, okay? And I'm looking at the current market of GBP USD, okay? Now I can take from like, let's say low point to low point over here. I don't know if that's the best low point to use, but I can use low point to low point, or maybe from, let's use that first low point right over there. All right, there we go. I use that low point and then I use this low point, and look at what happened inside of the market. Look at what happened over here. Okay, there was a time elapse. I'm going to stop using the tools because it keeps slowing down the computer. But boom, the market came over here. There goes a time elapse. Market turned over, right? The market was going sideways, time elapse. Market kept going down. Market was coming down, time elapse. Market turned around and started coming up. Okay, so you could use this in so many different fashions. And as you get bigger, and as you get better at trading inside of the market, you can use this more over. Let's take a look at a much smaller market sequence over here. And again, this is my least favorite. I'm going to show you my favorite one. It's going to give you some really good bot zones. But if you use this properly, this can really help you be next level. So let's say I want to go from low to low on this time elapse right over here. Okay. Let's actually push this over to this wick. Okay. Trying to identify time elapses down here. Let's say I try to do from high to high over here. I don't know if maybe this is the first high, that's the second high, kind of doing something like that, using time elapses like that. All right. So fib time zones will help you. And if you see, they're very powerful. They are very powerful indeed. It's just about knowing how to use them. So they do very much exist inside of the market. All right. Now, moving forward over here, let's go over to my favorite. Let's go over to my favorite time-based analysis. And you guys are going to love this right here. Now, this is something I have never taught, or at least I don't believe that I taught this on any of my previous sessions. So you get to learn it right here, right now. And this is going to, and when I say this is going to help you really identify your entry points in the market, you're going to love it. So this is known as the trend-based fib time levels, okay, or what we like to call time travel, all right? So Fibonacci trend-based timelines is an analytical drawing tool used to predict the future price movement on the basis of applying Fibonacci sequence on the time axis. So you know how we like to use the Fibonacci retracements from high to low, and then the market can pull up 1/3 to 2/3 of the swing before continuing? Well, let's talk about this. Trend-based fib timelines is represented by a series of vertical lines at a date or time levels that show probable price corrections in an existing trend. Meaning that just like how, again, there's a high, a low, and then a 1/3 to 2/3 retracement, there is also a time lapse in terms of what was the time travel of that correction. Did the correction complete in 1/3 of this time? Did the correction complete in 2/3 of this time? Did the correction complete in twice 100? Did the correction complete in twice the in the equal time that the original swing was? This right here, ladies and gentlemen, is going to be next level, because this is time and price analysis at its finest. So now we're really going to have some fun, and this is a sweet treat to end off today's boot camp. So you can do two things. You can do the trending swing points to find the retracements, or you can do the trending swing points to retracements to find the extensions. All right. So let's just talk about the retracements and how we can use this. So I'm going to come over here. Let's remove drawing tools and let's do this. All right. Now watch this. I want you guys to look at each of these swing points in the market. All right. Let's look at each of these swing points inside of the market, right? So we have our swing high. Okay. We have a swing low. Okay, that was a swing high. Then we have another swing low. And then we have another swing high right up there. The market swings back kind of like to that low. And then we have another swing high right over here. So I'll use it on bigger, and then I'll use it, and then we'll drop down into smaller time frames and use them. So now check this out over here. So let's come over here, and then let's use this very, very first area, right? Okay, so as an example, let's say we're coming over here, and then we're going to use this swing point right here in the market. All right, now the reason why we're going to use this swing point is because this was a huge area of supply. So if we back up out the chart, you see that wick right over there? Boom, there goes the wick. We were waiting for price to come back to that wick to fill in that liquidity, right? So we can see, let's come over here. All of this was still uptrending. Okay, that was all still uptrending. And once it made that wick, from there, what are we technically looking for? Now you're looking for the market to potentially swing down to an area of support in the market, and then you're looking for the market to swing back up like that, right? All right, so let's do something like this. So a trader will take the Fibonacci from high to low. Okay, they'll take the Fibonacci from high to low. I'm gonna just drag this all the way out, right? They're taking the Fibonacci from high to low, and they want to see where this market is going to extend to. Now, when you use the trend-based fib tool, What you do is that same swing high to low, you do the swing high and you come right down there to the swing low, and now you plot it, okay? And you plot it right over there. Now, what I want you to see is that these time zones, 0 is where it starts. You have 38.2, you have 618, you have the 100, you have 138.2, 1618, 200. These Fibonacci numbers is representing the time travel in terms of the swing. So the retracement, as you guys know, is the retracement, right? It usually comes 1/3 to 2/3 of the initial swing. That's what the market typically retraces or pulls back to. Now, the time travel is, did it take 1/3 or 2/3 of that time to get to that level? So what I like to do is I like to do this. If you are expecting the market to come to the 618, you look for the 618 right there in the market. You look for the 618. And now I'm going to box up the 618 zone. I'm going to box up the entire 618 zone right over there. So you see, I took the start of the 618 and I took that 618 and I basically created a box right over there in the market. And by doing that, you can see that this helped me create, let's get out of here. This helped me create a time and price analysis on the exact area where I believe that this market is going to, in fact, turn around. And bingo, from there, we had a nice drop off. Not only did the market, come back and hold that, but from here, we had a huge drop in the market and the market continued to drop off, right? Now, let's continue to use more swing points in the market. So now let's say we're going to use this swing point. So let's go back to using our Fibonacci's. And let's say we're going to use this swing high now, because that was the last swing high, to this swing low over here. Okay, bingo. All right. Now, lo and behold, we have again, 1/3 to 2/3 is usually the pullback level. Now, the first swing is usually the 618. So remember, we talked about on the previous beginners bootcamp that if you take a 618, these levels also help you strengthen or verify or confirm your supply and demand levels or your support and resistance levels. So there's already high probability that this is a retracement level just because there was a previous level of structure right over here, right? But let's continue to incorporate time and price. So I'm going to take the trend-based tool. I'm going to do from the high to the low, right over there. And now once I do the high to the low, right over here, now I can do the first low, the second low, or the third low. Now I like to use the last low before the market starts actually turning up. So this was right when the market started downtrending, and this was the last point before the market started uptrending. Now, if I look over here, let's look at the time lapse, 38.2, 618. I'm looking for a 618 retracement. I'm going to take the 618, right there on the fib time zone. You see that, the 618? I'm going to take that 618, and I'm going to box up this entire 618 right over there, and bingo. What do I have over here? Let's get rid of my Fibonacci's. I now have an exact area where I'm expecting the price to stop and start reversing. And did it do it? Yes, it did. And it's fantastic. Let's actually drop down into lower swings. Okay, let's drop down into other swings inside of the market. Okay, let's say I want to use, let's come back over here. Okay, let's say I want to take this high to this low, right down here. I am going to attempt to identify where the market is going to pull back to over there. Okay. Boom, high to low. Again, here goes your areas of like support and resistance and stuff like that. Okay, very, very nice level. Take a look. Okay, So what does a trader do? A trader says, oh, well, you know what's going to happen? Once they hit the 618 up here, the price dropped down. It's going to find the retracement, and it can't drop forever. So eventually there's going to need to be a pullback, right? So boom, now we go into a contraction, right? That correction where the market is taking a break. There goes that 618 level. Okay, let's take the trend base fib time. So I'm going to do the high, and then I can either mark up the low all the way here. Okay, or I can mark up the low right here when the market started pushing up. I'm not sure if I should use this low, if I should use this low. Let's come over here. Where's the bullish candles when the market started moving? I guess right here. That's where the market started moving up. Yeah. Because remember, you're supposed to use the point where the market finally stopped coming down and started coming up. So this is what I'm looking at. So you see it came down, it went up, it came right back down. And then from this last red candle right over here, that's where the market actually started pushing back up. Now what I'm going to do, I'm going to take my 618 box and my 618 box right over there. I'm going to mark that up, and bingo. And right over there, that's exactly where I'm looking for the market to come to. And look at how the market just wicked in that area, just wicked in that area, and then bang, came on down inside of the market, right? So this is very, 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 very big in the market. And again, you could use it for wave after wave after wave after wave, whatever it is that you want to use it on. Let me do it again one more time. Let's say I'm going to go from high to low, right down here. Okay, whether I could be using this one or I could be using that one, high to low. You're going to use my trend-based time from high to low. I'm going to open that up. And then what am I going to wait for? Oops. Okay. There we go. What am I going to wait for? I guess I could use this one. Right. That one there. There we go. Okay. And from high to low, the market pushes back. This is 38.2 to 618. Here goes my 618 zone right over there. I mean, this kind of has, all this is already trapped up in there, but whatever the case is, boom, right over there. 38.2, 618. We open this up and boom, we get an exact area where we expect the time to come and then turn around inside of the market. Okay. Now this is incredible. Now, not only can you do this for retracements, but you can also do this to help you find market extensions. Okay. You can also do this to help you find market extensions. So as an example, let's just use over here because we're already here and I just don't want to move the mouse around too much. All right. So let's say we are, okay, from here to here. This was about a 50% retracement. Now watch this. I'm going to do 2 and 2. So we have a 50% retracement. I'm going to do one last example of the fib time zones. So that came around the 50%. Oops. Okay. There we go. You have that 38.2, that 50 to that 38.2 to that 618. There goes that box right over here. Bingo. That was the exact price that you needed to finish before you see the turnaround. See how amazing that is? All right, now let me take these Fibonacci's and then let's turn these around and let's reverse them. Let's extend them. Now, where do you typically want to see price come to? Again, that 138.2 to that 1618, right up there. Okay, bingo, right up there. Okay. Now, remind you, there's already lots of commonality at this point. Okay, there's already lots of commonality at this point because if you use the Fibonacci's as speaked about or a price cluster, as we speak about, let me unreverse these Fibonacci's here. Whenever you are using two Fibonacci's at two different swing points and they all line up at one area, you have commonality. So as you can see over here, GU had an exceptional level of commonality right over here. Okay, so this here to here was giving you the retracement, and then here to here gave you that extension that you was looking for. But let's say you wanted an exact time and price. Like, what if the market came up here and then consolidated and then didn't turn around and then drop down? Do you want to be in the market for all those hours? Or do you want to find a specific range where you are anticipating that market to turn over? Well, okay, this is what we now use the time-based fib to find the extension. So remember, to find the retracement, you simply do the swing, boom and boom. You find the swing, okay? But to find the extension, okay, when you take the swing, all right, what you're gonna do is you're now gonna take the swing from low to high, and then there's a third place where you can push it. Now you push it all the way to the low, down there, boom. So you do the swing and the pullback, right? So there goes the swing, there goes the pullback, and now you're looking for the extension. So remember, the extension, let's come back, let's take the fibs. Okay, so let's say you have the extension from over here. I think I was using this entire wave. So that was the 138.2, and I was doing 618. Let's just continue to use this for now. Okay, so let's say you was around that 138.2 to that 160. I'm going to come right over here to my fibs, and I'm going to look for my 138.2 to my 160. You see the 138.2 to the 160 on my fib zones? So I'm going to come over here, and my 138.2 to my 160 right here in this price zone. Boom. Let's get rid of this. Not only was this the zone, but also the time. Look at how the market whipped into that time box and then turned around. Can you see that? Can you imagine trading at this level? What would you do if you could trade at this level, ladies and gentlemen? It's extremely, extremely, extremely important. So let me come over here. Let me give you this last example. Now, if we look over here, let's say we're going to use this entire swing. Now, this is going to be a very, very big swing. I'm going to see if I can find any commonality. I'm going to try to show you something in real time. So let's take a look at I want to see some commonality. Okay, so here are some of my zones. Okay, so this is giving me a 138.2 here. This is giving me a 150 here. And this is giving us a 1618 here. Okay, and that's measuring the entire swing. Now I'm going to reduce the swing over here. Okay, and we don't really have any commonality lining up in that particular market. Okay, if we use this swing, which I didn't want to use, let me actually use this swing. Here we go. Let's use this swing over here. Okay, so now if I use this swing in the market, we have 50 to 618. Okay, so there is more price clusters in this particular area. All righty. So first thing that I just did was I just looked for some extension levels. Now that I found some extension levels, I'm going to try to verify these extension levels over here to see if this is a good level in the market. Are these good key levels that's happening over here? Now I can go even further back in price. But as you can see here, look, we have stop and reverse, stop and reverse, stop and reverse, stop and reverse, stop and reverse. So this is already showing me that this is a pretty important price zone. Okay, that's great. It's a good price zone. All right. Now let's try to do some fib extensions. Let me see if this would work from here to here. I don't believe that this is going to be a big enough extension, but we're going to see. All right. Boom. So now we're going to do from high to low and we're going to pull back. Now, again, we're between the 130 and the 150. So I want you guys to take a look. Look at the time extension right over here. Here goes the 130. 130, 150 is in the middle. 1618 is right over here. So if you can see right over here, remember that extra 1618 was all the way down there. Let me show you this again. Let's go from here to here. Okay. And you see how the 1618 is all the way down here? Okay. And then here goes your 1618 crossover. Boom. All right. Okay. So based on time and price analysis, ladies and gentlemen, okay, based on time and price analysis, looking at the current GBP USD market, this would tell us, because I know some people wanted like some real-time examples, this would tell us that these are the two price zones that we want to ideally see a price reversal in. And as we can see right now, it's pretty much dipping, right? It's starting to dip right into this area. So the market can even dip a little bit lower and then turn around. So these are going to be the areas that I would look for a potential reversal on GBP USD. All righty, ladies and gentlemen. So anyway, getting ready to go back to the charts. We're going to conclude. This is going to conclude our FRX Beginners Bootcamp Part 6. It has been an extraordinary day, an extraordinary lesson of trading. Ladies and gentlemen, so let's do a quick recap before we wrap this up to talk about what was the purpose of today's bootcamp. So Beginner Bootcamp Part 6 was beginning to, now that we have, again, we understand the circumference of trading. We've gotten the highs, the lows, the supports, the resistance, the breaks, the retest, the pullbacks, the indexes, right? Now that we have all of these tools at our arsenal, now it's to the point where we need to begin applying. And in order to apply this information in the market, we have to understand, we have to create a base analysis. And we discovered different types of ways to interpret a base analysis. And before we did that, we gave you guys the understanding that the market is always changing and that it's never fixed. Okay, so you're going to have to adapt to different conditions or always trade the same setup. So the base analysis that we went over was discovering the market cycles, the accumulation, advancing, distribution, and declining. We went and touched on what was wave analysis inside of the markets. We touched on what were market levels inside of the market. We then dove a little bit into price patterns and how price patterns can aid you in the expansion and contractions of prices between the levels and the waves and the cycles. And then we began to train on how to incorporate time analysis for market cycles and how to incorporate trend-based fib time levels to pinpoint areas of price and time reversals with higher probability. All right. So you guys want to make sure that you continue to review today's lesson over and over and over and over again. All righty, ladies and gentlemen, I'm so happy to be able to be here, to be your trainer. Thank you for trusting me, for being your FRX master educator. This is an immense amount of knowledge and information that you are learning that far exceeds 5 years of membership fees an IM Mastery Academy. Some of this information alone can run you $5,000 to $10,000 for a single concept. And we are giving you all of the information in one beginner's boot camp to really open up your eyes and really open up your mind to the world of Forex to help you become a long-term profitable trader. Because yes, there is a future in Forex. Now, one more time, guys, before we get ready to wrap this up, please remember that, I ask you guys that you come right over here to the live stream, and right where it has this little, where it has the little survey, please click on that and leave me, if you found value in these boot camps or any of our previous training sessions, please leave me a 5-star review, as well as some comments that you guys would like me to take into account. The ratings are extremely important for us as educators. And don't forget that you can go to the favorite sessions to begin to get the classes to dive deeper into some of those price concepts. And one thing that I was asked continuously was, how can you keep in touch with me to keep up with trainings and any live trading sessions that I'm doing inside of the market? So just don't forget, I just wanted to throw that in here for today. Please don't forget that you guys can go to your IM Center, okay? And in your IM Center, 1 second over here as this loads up. When you guys go to your IM Center on your desktop, or by downloading the IM Academy app, give me 1 second, or by downloading the IM Academy app on your mobile phone, whether on Android or whether on Apple, you're going to have the ability to look into something known as Pip Talk. Pip Talks are private channels and communities by different educators and different strategy developers inside of the community. You can find me there on Pip Talk and subscribe to my channel to be able to keep up with any sessions or any live trading sessions that I am doing here within the market. So once Pip Talk is open and loaded up for you, you're going to have the ability to subscribe. And if you do subscribe, what's going to happen is anytime I post an update regarding a session, a recap, or any live educational analysis that we're providing that you can trade live in, all of that information is going to get put here. You have the ability to like, and you also have the ability to comment. So it brings me great joy by showing that you guys are actually engaged and learning from the trading. So if you guys can, simply please hit those like buttons, hit those comment buttons, and then let me know that you guys are here and that you guys are working with us, you guys are learning with us, and you guys are enjoying all of the education. All right. So anyway, with that being said, guys, we're going to get ready to wrap up today's FRX Beginners Bootcamp, and we'll see you guys in part 7 of the bootcamp.